Hello, my name is Przemysław Kwiecień. I'm Chief Economist of the XTB, and it's my pleasure to start the week on financial markets with you. In today's presentation, we talk about toxic options, options that are fueling Wall Street rally and really influencing most of the markets worldwide these days in this weird pandemic year where you would think that economic issues, economic troubles would have a significant negative effect on the markets. We actually see the opposite, and these options are one of the reasons why. So this is the story for today for us, but we'll start as usual with top news and quick talk on the key topics before we get there. So starting the week, markets remain relatively high despite the flow of bad news, including hard lockdown in Germany, where the COVID situation remains bad. Risk of hard Brexit, even though there is some discussion be continued between EU diplomats and UK side, and there is still hope of some kind of Brexit deal. And frankly speaking, personally, I think that there will be something. I mean, it's really so hard to believe that two sides could risk, adding another huge negative factor to already struggling economies. So I think some kind of deal will be achieved, and that's the hope on Monday morning. But also we have no deal in Congress, and it doesn't seem like anything substantial could be done in the near term. And additional factor that was somewhere there for a while, but was actually quite overlooked by the markets is that US big tech is being prosecuted by a federal trade commission, and the commission last week signaled it wanted Facebook to shut both Instagram and WhatsApp, a move that would certainly be a huge blow to Facebook, and on one hand it reveals how serious these things could be. On the other hand, the market reaction was surprisingly limited, showing that markets really do not believe something of such magnitude could happen. We'll see. However, moving to Europe, back to Europe, we had EU budget deal last week, so that's certainly a positive, and that actually overshadowed the ECB meeting, something that I'll be discussing very quickly on one of the next slides. And calendar for this week covers a lot of US data. Actually, we have US output on Tuesday, retail sales on Wednesday, flash PMIs from Japan, EU, UK, US on Wednesday as well, and most importantly, FOMC meeting and conference on Wednesday in the evening actually. So the calendar for this week is actually quite intensive. This is the last week, let's say full week for the markets, so there will be full focus on these releases. So certainly Wednesday is the day that you want to have your eye on, but actually for the whole week it's certainly the time to still be active. Okay, let's move on to the macroeconomic section. Disappointing data from the US. The situation seems that the US is losing pace a little bit from this reopening stimulus push that we had during the summer and early in the autumn. We had deteriorating claims last week. The initial claims, that's the chart on the left. Actually, this is continuing claims, but initial claims is a weekly report on how many people want to get unemployment benefits because they lost their job. And the number not only increased last week, but increased the most since March. Obviously, it's weekly data, it's a bit volatile, but still it seems like the labor market is hitting the brakes right now. And on one hand, it adds political pressure to forge out this stimulus package, but on the other, it shows that without the stimulus, the economy is already struggling a little bit. On the right-hand side, inflation, which was more or less in line with expectations. Headline inflation slowed down to as little as 1.16. However, core inflation accelerated slightly to 1.65. What's important here is that inflation will be rising in the next year, especially during the spring, partly on the base effects, but the key question is what happens in the second part of the year. Because like I said last week, the real risk is that with all the stimulus finding its way to the economy next year when the reopening happens on the vaccination and things like this, and at the same time, some companies are gone. Some have limited their investment, so the supply side of the economy could be limited. And if you have less supply, more demand, obviously from the basic economics, it means that price is going up. And if that means higher inflation in the second half of next year, that could be something very hard to swallow for the markets, because right now central banks really pray that inflation is not going to rise significantly, because that would force them to increase interest rates, or at least have markets speculate about it, and that would really be bad for anything from equities, through bonds, through commodities. So right now inflation is low, but keep an eye on it, especially in the second half of next year. All right, the ECB last week, really not so much to talk about. The ECB was expected to extend the QE program further into the future, and that was done. It's already confirmed until March 2022, with reinvestments confirmed until March 2023. So for more than 2 years, the ECB is already pledging, look, we're going to be printing like mad. The sad reality is that it doesn't really affect the economy anymore, because the policy, monetary policy being that extreme, it can have an effect on the economy if it's going to be treated like intervention. But intervention obviously cannot last forever. So from that point of view, the policy is no longer having a massive impact on the economy, whereas it has other side consequences, like transferring wealth from middle class to the richest one, because of the negative real interest rate on savings, and reducing long-term economic potential, because quite simply, if the ECB is steering all the capital allocation in the economy, obviously it's not going to be as efficient as it would be if it was driven by the market forces. So sadly, the ECB policy is in a dark corner, and I don't see personally a way out of it. Neither do see, but they don't admit it. So let's move on to the Fed. As I said, we are going to have Fed meeting this Wednesday in the evening, and again, do not expect big changes, because obviously, like the ECB, they are pressing pedal to the metal. They are pumping $120 billion of QE a month, which is a staggering amount. Just for sake of comparison, in 2018, for some time when they tried to reduce their balance sheet, they were taking $50 billion a month from the market. So right now they're adding more than 2 times that much a month. So obviously this policy is going to continue for a long while yet, but the interesting part of this meeting will be a combination of economic projections with what Powell is going to say, because with the vaccination already starting in the US this Monday, actually, the Fed's Powell was saying for quite a while that vaccination will be having positive prospect on the have positive impact on the prospect of the US economy, and that's now the reality. So the question is, to what extent will economic forecasts improve on that? So that table is something to watch on Wednesday. So we should expect some improvements here. The question is how it's going to affect, for instance, core PCE inflation forecast, because as you see, and what I was saying is that markets really believe, and the central banks believe, that inflation is never going to rise significantly, and you can see it in projections. The core PCE inflation is projected to be below 2% until 2023, and then just match this 2% target of the Fed 3 years from now. So obviously I don't expect this figure to change much, but keep an eye on it. And if the forecasts improve, the question is what the Fed could do to contain expectations of limiting policy support. And that's my expectation is Powell is going to claim that, look, yes, we are more optimistic on the economy, but we still need to provide as much support as we were doing in second half of 2020. So the question is obviously how the market reacts. This is always fragile with S&P 500 at all-time highs. You could always have some kind of correction just like this. So certainly these two things are something that I will keep in mind. Before we move to the story of the week, one look on the commodities, and it's copper today, where prices are rallying like mad, but at least in this case it's supported to some extent with the fundamentals. Of course, we have a lot of hype. Like I said in this title, there is hype plus fundamentals. The hype part is all this vaccination optimism, is reopenings, prospects for next year, strong growth, all of this, but there is some truth to that. If you look at this chart, you can see the orange line is inventories, and you can see that inventory levels are already very low in the historical context. And if you look at also the relationship between copper and gold and their relation to US bond yields, you could see that there is a prospect for copper prices in this positive environment to rise further. Obviously, like I said, it's no longer cheap, it's no longer undervalued for sure, but there is a lot of optimism. And for instance, Goldman Sachs estimates that copper prices could rise to 9,500 within the next few months, so in a relatively short period of time. And if you look here, we are just at less than 8K right now, so still, at least from the Goldman Sachs forecast, a long way to go. You'd think that, and certainly you would be right saying that from March copper prices really surged, but compare this to what happened between 2009 and 2011, 2 years of absolutely massive growth. Obviously, the situation is slightly different right now, but comparing this move to what we had back then, it's obviously staggering that how much this could still rise before we could go to all-time highs. Anyway, like I said, it's no longer a cheap market. Obviously, there's been a lot of momentum, so you could say, okay, some kind of correction would be healthy, but we have no guarantee it's going to happen because there is a hype and there is some fundamental case behind it. All right, let's move to the story of the week: toxic options. Why are they toxic? Let's start with why we are actually talking about it. In US, as you can see from this NASDAQ article, the number of the volume of option trading is up 125% year over year. So it's quite massive. And the question is why? Well, some very quick introduction on what stock option is actually. For most of you, I guess this is known and you are quite familiar with this, but for the sake of clarity, let's just give this very short introduction. Basically, call options give you a right to exercise some action if you think it makes sense for you. So to give you an example, in a call option, if you are longs, that means that you buy option. You have to pay some premium. So let's say you pay $2 of a premium to be able to sell a stock at 100 in 3 months time. Yeah. So you don't need to buy the asset. You don't need to spend the whole $100, but you just spend $2 for the right to buy the asset 3 months from now. And let's say 3 months from now the asset is 110, and if you paid just $2 of a premium and the asset is worth already 110, obviously it makes sense to exercise the option. In the reality, usually these options are not exercised, but you just sell the option before expiration, so you can reap the huge benefit. So on this example, you could see that the asset rose 10%, but the option value would rise from $2 to $10 for it to be, let's say, to make sense. So you'd make 400% on the assets that rose just 10%, right? So I guess that already should give you an idea why we are calling this situation quite toxic. But before we move on, you also have put options where you can sell the asset at a certain price in the future, if it makes sense, to you. So let's say you actually have equity position in your portfolio and the stock price is 100 at certain point in time. You buy a put option to sell it at 95 in the future and pay $2 of a premium. You'd think, why do I want to buy option to sell lower than I have today? Well, let's say you want some big portfolio and you want to stick with it, but you just want to hedge yourself, your portfolio against some very negative downside scenario. And let's say in that scenario, stock prices tumble and your stock is worth only 80 at the date of option expiration. So if you have a right to sell it at 95, whereas the market price is 80, obviously it makes a lot of sense suddenly to exercise this option. So this is what basically these options are meant to be. Normally for investors, a lot of investors use put options to hedge their portfolios against negative scenarios, whereas call options are usually used to add some return to your portfolio for some scenarios, but usually they are treated as an addition to some strategies on a broader portfolio of instruments. Whereas in the US right now it's quite the opposite. If you look at this chart, you can see a relationship between, here in the upper part, between put and call options. This is called put call ratio for good reason, because it shows how many call options are there for each put, right? So you can see that even for Nasdaq top stocks that are usually hot and people don't like to sell them or protect them, because if they are rising like mad, why would you decrease your return by buying protection? Obviously I'm a bit ironic here, but that's normally the market thinking. And still you can see that for a long time this put call ratio for those hot stocks was close to 1, right? So there were quite a few puts actually around protecting the portfolios. And when the pandemic came, it resurfaced a little bit, but then as you can see, this put call ratio really tumbled to less than a half right now. At the same time, you can see that the volumes were what they were in the past, and now they're pretty much doubled from what they were before the pandemic. What it means is that from here, you have explosion of option calls. And why is it there, you would say? Well, there are a couple of reasons. First, some of the reasons are that because of the pandemic, traders stay at home, they have more time, many brokers started offering free trading, and all of these arguments are valid. But I think that the most important, and actually the most scary argument, is that investors in the US started treating options like call options like a substitute for equities. Because like I give you this example, if the asset prices rises by 10%, but if you buy not the asset but the call option, which is long out of the money, and you can make so much more on it, then why buying equity if you can buy options and if stock prices only go up? Of course they do not only go up in the long term, but that's the market thinking right now, that the Fed holds this market up, that they will not allow the correction to materialize, and therefore why just narrowing down your returns to equities, whereas you can buy options. Obviously this is very risky, and this is something that we saw materializing for a short time in September, where traders were very aggressive purchasing call options on stocks like Tesla, like Apple, like other hot big tech names. You can see this red part is top 10 Nasdaq call options. They were dominating turnover in the options, but since then actually the flow turned to a broad market. Right now, as you can see, top 10 Nasdaq is no longer having such a big share in this overall volume, but you have some newcomers like Zoom, Neo, Palantir, Nikola, Uber, but actually the biggest share comes from here, which is a very broad market: stocks, indices, ETFs. So that's only confirms what I was saying, that investors started to treat call options like a substitute for equities, and that's dangerous because that means, and also this example, Carnival, this is a company that offer cruises, and the company really suffered during this pandemic year, but now with this vaccine optimism, stock prices started to recover, and suddenly look how much this translated into option activity. So that shows that actually investors think that they can easily ride this rally, amplifying their return with the call options. And obviously the reality is that whenever a bigger correction happens, they can lose all their money on them. So that's risky, and that can amplify any downside movement. Of course, we don't know when it's going to happen. Even if you look at the charts, you can see, turning to S&P 500, you can see that last week we had some attempt to go lower, but the market really defended it fairly well. So it's always hard to say when something like this could happen. On Nasdaq, again, this is a situation from September caused by, amplified, let's say, by the option market, where we had rally, and then suddenly a very sharp drop down. Last week we had one day of this, let's say, quite scary declines, but as you can see already, the market's holding up relatively well. So unless there is a really big fear factor, this situation can of course evolve, and we could see prices going up, even if we think that the overall news flow is not so positive like we started this webinar with. But it's worth bearing in mind that at some point, if the risk factor is big enough, then all this speculative capital will be trying to quickly escape the market and can amplify the downside movement quite a lot. So, ladies and gentlemen, that's it from my side today. Like I said, it's going to be quite interesting week because we have a lot of releases, especially Wednesday with the FOMC meeting, but we have also very interesting markets. On one side, a lot of you would think negative news with COVID still huge in US, in Europe, new restrictions in Germany, Brexit uncertainty, Congress deal uncertainty. On the other hand, like you see, optimism on the markets, indices rising, defending corrections very quickly, dollar weakening. So the question is, can the market hold this up for the remainder of the year? We'll see. 3 weeks to go. This week is the last one that's really going to be fully traded. Have a good week. We'll see each other next Monday, 7:30 again.